Hello, Culture Matters Podcast. Before I introduce you to our guest, here's a quote just for this episode. I like to say experience is what you get when you didn't get what you wanted. Howard Marks. Our guest today is a regular on the Culture Matters Podcast. They're actually the co-host of the Value Investor series. If you haven't listened to those episodes, type that in on the Culture Matters Podcast Value Investor series after this episode for so many great guests. Our guest today has been on episodes 221, 336, 963, 892, 470, and 513. Just them. And today we're doing the quarterly update with Arena Securities with our guest, Aleck Arena. Aleck, thanks for coming
Thanks for
on.
having
I'm
me on, Jay.
excited.
It's always a pleasure, mate. It's been too long between drinks, as we would say in Australia. Yeah, really excited to be on today, and yeah, share what's happened in the last quarter. Jay's turning this into an analyst call for the. I feel like I'm reading my quarterly financials, but not quite, but close to it. So I'll see how I go because haven't I haven't I haven't pretended. I haven't done mock like CFO roles before where I've read the numbers off to the market. But yeah. So effectively in this quarter, um, Arena Securities just had a bit of a bounce back from the tariff debacle, which was the quarter previous. So yeah, the market performance was pretty strong. It came in at about 6% for the quarter. Um, it's obviously a fairly different picture now, being nearly a whole quarter later since my last quarterly. So this one was written till the end of June, and obviously now we're in September. So I'll write another one at the end of this month, and it will be published on the website. Um, so pretty much what happened this quarter was RPM Automotive Group. It's a company that's based on the east coast of Australia. They're actually not on the west coast yet. They sell car parts, equipment, four-wheel drive equipment for utes and trucks and those types of cars effectively. They still sell tires for like SUVs and sedans, but their target audience is like four-wheel drivers. Um, I don't know what you call that in America and Australia. We call it bush bashing, but
Huh.
yeah. Sorry if I've lost the audience there. So the recycling operation, sorry, they started a recycling operation in Melbourne. So now they're going to recycle tires. So before this initiative, they would have to pay for tires to be recycled. They'll have to pay to get them taken away, and then they would have to pay to get them recycled. So now they've got their own recycling facility. They've obviously got into debt to create the facility, but it used to be a cost line in the annual report. Like they used to pay for it, and now it's going to be turned into a slight profit line. They're not going to have cost behind it because the economics, you can make money out of tire recycling, and especially when you've in-housed it. So they've got lots of supply coming from where they sell tires from the East Coast. Obviously, in Australia, when you sell tires to someone and you're like a dealership, usually you take their old tires and you charge them like $5 a tire, and it's already embedded into the price that you charge them when you sell them their new tires. So they've got lots of volume coming from their existing stores, and they're transporting that down to their new tire facility in Melbourne, Victoria, and yeah, like how it looked financially, I would expect the company to save about $2 million a year, which is huge because the
Wow.
profitability of the company is only about $4.9 million after tax. Like it's not a big, it's a very low margin business because effectively they buy stuff wholesale and then sell it to the consumers. And if all goes well, I think the operation might be able to generate $450,000 profit after tax. And I said like that's extremely small, but the best thing about it is how much the company will actually save. And then they're turning it into the slight profit as I touched on beforehand. But yeah, that's kind of sums up RPM. And then I did. I feel like I'm gonna be rolling forever here, Jay. It was um it was quite an active quarter for me because I had a few positions that I I had a few companies because of the tariffs that I really liked, like the valuations had gone down, and I became extremely interested. And then I had a few companies where the valuations were not fair, but close to fair. So obviously, I've trimmed and sold those positions, and I've added to new positions that I've done work on in previous years, and I've identified as an opportunity. Um, so I did sell down my stake in Brickworks, which was extremely annoying as they got a takeover bid pretty much right after I sold. Not sorry, they didn't get a takeover bid. They got a they're doing a merger with Sol Patterson, which owns shares in Brickworks, and there's been a cross shareholding for many years. So yes, they because of the merger, the price of the shares went up, and that that sucked for me. But at the end of the day, it was opportunity cost because I did go other places and I made money at other places. But yeah, I wrote about Brickworks effectively, let my shareholders know what had happened because I've written about Brickworks previously, and I just wanted to be translucent to my shareholders. And if anyone else is out there reading my quarterly letter, that I just wanted them to know that I don't own the stock anymore. So yeah, that summarizes that. Um, Prophecy, I also sold down. So I touched on this one really quickly. And I think if you want to read about my prophecy um, sale, I would recommend going to my website and reading the report for yourself because I don't really want to touch on this one. I'm sorry. And then I also sold down Mineral Resources. So during the during the tariff debacle, the share price fell like 50% from where I bought the shares, and they were heavily in debt, and I knew they were heavily in debt, and it was a very small position. I thought they had a really good asset with Onslow, and I also thought the Holy Trade was okay. So usually when in mining, you have your amazing asset, your mine, and then you take the commodity from the mine to the port. And because mining is effectively a logistics operation, it's all about doing it, it's all about getting the highest quantity of ore and logistically getting it to the port at the lowest cost. And if you've got a lot of it, to do it in bulk is a bit cheaper. You also have more symmetries if the mine's a lot bigger. So traditionally in mining, you create a haulage track from the mine to the port, which is a train track. Trains and tracks, like I sound that sounds funny, but it's a it's a very expensive bit of infrastructure in the modern day. Back 50 years ago, it was cheaper, but like that was like obviously from 50 years ago to today, there's been a whole bunch of inflation. So it was cheaper, but it still with getting a commodity from one place to the other, it still is the most efficient way to do it. Mineral Resources effectively tried to cut a corner and they set up a haulage road. So they got big diggers, like big cat diggers effectively. Um, and they've just got these big pieces of machinery to drive down this haulage road. And then they've taken it to a port and obviously they've dropped it off at the port. The haulage road's supposed to it's a tiny bit too narrow. So they've spent billions of dollars on this haulage road, and they've ran into problems with it. Um, so it being narrow, obviously, as I touched on beforehand, you need to be efficient and fast and save money when you're taking the commodity from the mine to the port. And because the haulage road isn't really, because it's a tiny bit narrow, the trucks have crashed into each other because of the road being a tiny bit too narrow. So like imagine Jay, there's a truck going on the road from the right hand side, and there's a major truck going on the road from the left hand side. And if you're going at like 90 kilometers an hour and it's a fully loaded truck, the truck can just tip over. So Minres had that problem a lot. So I really didn't like that because it was the iron ore mine was the selling point of the company. They had a mining services division, and it was traditionally cash generative. It's a really good business. I think it's a moated business. Um, but the iron ore operation was how it was going to get its next leg up for growth. They also own these lithium assets, and the lithium price is below their cost production, so they're actively losing money on the lithium assets. And they went into a bunch of debt to get the iron ore asset up and running. And it's effectively still having teething problems, and the debt repayments would be close to 600 million Australian dollars a year. They've got about $6 billion of debt. During the tariff debacle, the debt was worth more than the current market cap. And after the tariff debacle, the share price bounced back effectively to where I bought the shares. And I knew, I then knew more about the haulage road than I did previously. And the company stacked on an extra, I think, 400, $500 million worth of debt in that time. And I was then doing the math, and the math had changed slightly. And you've gone from them being able to pay the interest repayments and pay down the debt slowly to the interest repayments from my liking just getting a tiny bit too big. And they're completely eating profitability. And I think it's going to affect the company's ability to pay back debt unless there is some mining super cycle or boom. So I did sell out of mineral resources because there was better opportunities. So I did get a bit lucky that the share price rebounded, and parts of the market that I knew quite well were still down a bit. So I was able to allocate my capital somewhere else. So long story short, what I wrote to end the mineral resources write up was like I like the assets of the company. I don't like the amount of debt it has at all. And I'm not sold on Onslow. So I said like I've done heaps of research on it. I said shares aren't like ex-girlfriends, Jay. You can always go back to shares if you know lots about it. You've already done the work on it. So I said, like, if an opportunity presents and they pay down the debt, I'm happy to open a position again and buy the stock again. But for now, it's got a bit too much risk in it for me, and I think there's better opportunity elsewhere. And it doesn't mean I won't go back to it, but yeah, we'll see. Obviously, the circumstances have to change. Um, I also bought shares in Motio, so this is where I allocated the capital from the previous share sales. So I have had my eye on Motio for quite some time, and I wanted to see a bit more execution from the management team. And I believe they've done that. They upgraded twice last financial year, and I talked about the valuation, how I value Motio, which is a bit different to um, all the other companies in the portfolio. Um, so I do value. I don't know how to say. I feel wrong saying this, Jay. I feel like a fraud, mate. The so Modio has lots of tax losses. Um, from they bought this previous subsidiary of O Media the CEO at Motio used to work at O Media. He knows the business quite well. I think Adam's a really good operator, but they cut a long story short, Jay. They have $18 million of tax losses, so they don't need to
Oh,
pay tax for a while. So you know what I'm actually doing, Jay? I'm valuing the company off their EBITDA because it's not bullshit earnings for this scenario. Because they're not going to need to, because they're making like $2 million a year and they've got $18 million in tax losses. So they're not going to need to pay tax in like close to 10 years. So
wow.
I just, I can hear an old man just shouting at me, but maybe that's Charlie Munger. I don't know. Are you still there, Jay? I thought you would have crashed out over this. This is the only time that I've ever valued a company off EBITDA. Geez, I just felt my body just doesn't feel right saying this. I feel hurt. Um,
Thank you
I
all
can
for
actually,
listening to the Culture Matters podcast. We're discontinuing the Value Investor series.
but
We're
I can see Charlie
discontinuing.
Munger up on stage, and he's just sitting there like bullshit earnings. But yes, okay. Charlie Munger has a fair and reasonable point. I take my hat off to him. I agree with him. Um, in this minute circumstance where they don't need to pay tax, if you get this adjusted EBITDA, you can work out a value for it. Okay, Jay. Jay just had a heart attack on podcast. I think we should stop now
we're
because
taking
he's
that.
gotta go.
We're taking that clip and we're putting ads behind it on social media.
Oh fuck, no,
Arena
no. I
Securities.
can see me being cat, mate. I'm not
Yeah.
Kathy Woods. I'm not like I'm
Yep.
not going to start spooking Tesla and being like, oh, if you take their 2030 EBITDA, extrapolated it on current growth rates. I'm just saying, like, I think the shares are cheap, saying if their earnings hold or at a similar level at today's current price, because the amount of cash they're getting from the business is close to the EBITDA number. So to value it in the amount of cash, you get a share that's cheap to, yeah, well, you get a share that's cheap. I don't like to come out and say that, but that's that's the reality of it. And I think Adam knows, the CEO knows how to operate an advertising business very well. His previous experience speaks for itself. And there's also a fund manager on the board. He owns about 20% of the free float and he understands capital markets extremely well. So I am all it also makes me comfortable knowing that he's there because I know they're not just going to blow a bunch of money on a stupid acquisition
Mm.
because he knows capital allocation really well, this guy. Um, and yeah, I think he'll provide great like guardrails for Adam and she'll help him with any capital allocation and capital market stuff that comes up, which not all companies that are listed have. A lot of them have experience in the area that the company's listed, but there's not always a capital markets guy on the board. There's not always a fund manager on the board. Sometimes that's a red flag because they're on the board to help themselves. But here, I think it's a green flag. I've met Harley before. Um, yeah, and I'm happy to leave it at that. I think he's more than competent, and I'm happy he's there. Um, and then there was Karoon. So just 2 seconds. I need a slight pause. So I owned an oil company. I at the time of writing this, I still did. Um, and they have an asset in Brazil. So they make money off oil. It's pretty simple at the end of the day. But there was a bit of a war that happened uh, around was it June, May? You probably saw it on the news. There's a orange type of man in the White House. No disrespect. I think I don't know. I don't mind him. Very different type of operator, but yeah, I can't. Let's not get political views in the way here. But yeah, what happened was, um, and it's weird that I'm on an Americans podcast covering off on this because what I wrote in my quarterly letter was the US, they bombed Iran, and I said like that's not really a fair fight. But why I was commenting on the fight, like you can go ahead and do whatever you guys want. That's up to you guys. Iran, they said they were going to block the Hamas Strait, which is a major shipping route for all oil, and the US has got pissed off about that, and then they've gone and done what they've done. Not I'm not here saying it was the right decision. I'm not here saying war's good. I just want to get that clear. Um, and if they were to block this strait, it would disrupt 20% of the world's oil supply. And so the oil price shot up really fast, Jay. So then Caroon was getting valued on a oil price which I didn't think was going to stay at that price. So you had the asset, and then you had the oil price, which has moved up on a move which I thought was not going to. I thought it was kind of impossible because for it to stay at that price, they need to block the Hamas Strait, and like the Americans need to be incompetent and incompetent at war. And I thought that was impossible because the equipment that Iran had and the equipment the Americans have. I described it to like in the Australian Football League. I said it's like the team that won the Super Bowl playing amateur team. And they're not in the same ballpark. Like it's like the Philadelphia Eagles playing a high school football team. Like that don't make no
I
sense.
you
There's
could
no way
don't
they're going to be able to
include
block the Hamas Strait. Not in the. It's not the same league. It's like me trying to fight. It's like me trying to fight Mike Tyson. Like, pray for me. so, so yeah, I figured that out, and I sold my position because I thought the run up wasn't fair, effectively. So the equity price reacted to the oil price, and then I went, this share's now fairly to slightly overvalued. It's getting this premium, which is then going to be here for what I think is a couple of days. And effectively, I was correct in my decision there. Yeah, I the market was jolty and was scared and was like, we don't know what Iran's got. They might be able to block the Hamas Strait, and yeah, they maybe if the Americans didn't do anything, they would have been able to block it for a few days. But yeah, that involved the Americans not doing anything, which I think is crazy. Uh, but enough on wars. um, so I also bought some Adrad shares. So it's a small radiator business based out of South Australia, and like they exited a business in New Zealand, and some people might see it as negative, but it's going to impact the company's financials moving forward positively. At the end of the day, they just didn't have the scale in New Zealand, Jay, to make decent money. So I think shutting the business down in New Zealand because it was a loss-making business that they were trying to get scale for, and their idea was if we set up a warehouse in New Zealand, that to logistically get the equipment from South Australia to New Zealand is expensive, but if we already have equipment in New Zealand, it's much cheaper. So if you already have equipment in that geography, logistically, you get to save a bit of money. They didn't sell that much into the New Zealand market, so they've shut down the operation now, and it's going to save them $300,000 annually moving forward. So there was like there was a cost to shutting the business down, which was more than the $300,000, but that's just an impact on this year's profitability. So I think next year's profitability will see a minor bounce. I don't think profitability is going anywhere fast. I don't think it's going up fast. Um, I prefer it to be going up fast, but unfortunately, it's not. This business has near $20 million of cash on the balance sheet. It doesn't have any debt or very minimal debt. Um, its market cap's about 50 million Australian dollars currently, and it makes about I would call it between five and I would call it about 6 million Australian dollars after tax. So it's what you would call a value investment. Um, a co-founder owns a large proportion of the business. He does have he has there is related parties involved. So he does rent out some property to the listed business, and the property is in his name. From my time looking over the company, that's all been at arm's length. There's been nothing to complain about. I wouldn't describe them taking the mickey or pulling the piss. So I'm happy to sit there and hold stock. Radiators are a bit of a cyclical industry. So yeah, at some stage their earnings might turn and might tick up, but for now I'm happy to own the stock at a multiple of under 10 times earnings, receive my dividends. I, they get to stack the cash on the balance sheet, which is a value add for shareholders, as they can invest that money elsewhere. They can pay that out in a dividend if they want. Obviously, I don't advocate for them to pay all the cash out for in a dividend, because they need to sustain themselves. If a small acquisition comes up, they're in a good position for it. Yeah, I don't mind the stock at all, but mainly because of its price. Nothing about, like, it's it's a pure value investment. It's not growth at a reasonable price. It's just value. Um, so then Kit McGrath also had an update. Now, this is Jay's favorite company in the portfolio. So when I was in Pittsburgh, shout out to Pittsburgh, the former CEO stepped down, and me and Jay had a very deep and meaningful about the business. So during during the quarter ending in June, they hired a new CEO. I haven't spoken to her yet, but her credentials seem. I got to be careful what I say here. Her credentials seem very good, and yeah, the chairman, obviously Damien Banks, helped out in the hiring. Has been guiding the company ever since he joined the board and became chair of the company. Um, since he's arrived, we've seen a massive pullback in capex and a bit of a pullback in opex, so operating expenditure, meaning we've just seen a drop in company spending. Um, I think this is obviously positive because I'm not quite sure where the money was going beforehand. Um, it, a lot of it was going to an American business called Tutorfly, which they've since shut down. Under old management, they bought shares. They bought a business based out of Texas that was an online tutoring business, and ever since they bought it, it's just been making a loss year after year. I thought that was honestly, it was part of my thesis that that business got to a break even point, or it was shut down, and it's been shut down. So that should help the business's free cash flow moving forward. Um, I think for a small Australian tutoring business, they should be focused on running an Australian tutoring business. They've got a UK business which is growing well and a really good business, and they've got an international footprint. They just don't have anything in America. I think the American market and how it's set up around effectively in Australia, we would call it getting government grants. So getting work off the government and being in the school system, around the school system, is very different to Australia. And I think having a management team on the other side of the world is extremely hard. It's extremely hard to run a business when you're on the other side of the world. I've touched on it on your podcast before, Jay. Imagine me trying to run Culture Matters down here in Perth. Like,
Mm.
it's just insane. If you go on a holiday for a week or two, it's hard to keep running your company. Like, it's hard to keep running Culture Matters. And if you're doing that long term and you're over the other side of the world, it's extremely hard. And you don't know what your staff and employees are doing. Yeah, I, I feel like I'm done with touching on that now. Sorry I rambled to the audience for a long time, but because of them pulling back on capex and operating expenditure, we saw profitability go up modestly, but we still saw a loss from Tudorfly. Next year, we're obviously not going to see a loss from Tudorfly. And I think moving forward, we can see this business produce between $4 to $5 million in free cash flow. When I was buying shares in this business, it wasn't a valuation of $15 million with a tiny bit of cash on the balance sheet. Now they've got more cash on the balance sheet than they previously had. Revenue stayed about the same, even though they've shut down the American business, which tells you how well that was doing. Not very well. And obviously their margins have improved drastically, but it still wasn't a clean report because Tudorfly was still involved in that report because they only shut it down during, I think, June, I think midway through June. So I think this year we'll see a cleaner report at Kit McGrath. And yeah, I think the market might be a little surprised about its profitability and its margins. And yeah, we'll see. But I think the market will be a bit surprised because it hasn't really done the work on the business over the last 4 to 5 years. And for fair reason, the market's missed nothing. The share price has fallen from $1.30 to 30 cents and it's trading at about 62 cents today. And yeah, that pretty much concludes the end of my report. Obviously, if you guys have any questions, feel free to send me a text or email me. Though my number's on the report and my email address is on the website. And yeah, just
What's the website,
disclaimer.
Aleck?
Arena Securities, mate. I'm not a good promoter. I don't know the link. It's arenasecurities.com.au dash fund dash updates is if you want to go to the updates tab. But if you type in Arena Securities, I'm sure it'll just pop up on the internet. And can I please just say this is not a promotion at all. Please, I'm not a licensed financial advisor. Please don't run out and buy the positions I was talking about. My thoughts and opinions on the companies mentioned will change, and obviously you'll not be informed. I'm not trying to promote my product at all. Jay just purely wanted to know what's happened in the last few months. Yeah, that's what we'll. That's effectively why we're on the call today. Yeah, and obviously Jay's got a right to know what's going on. And if you guys want to keep up to date with me, obviously go to the website. But yeah, I'm not a licensed advisor. I'm not authorized to give financial advice. And please consult with a financial advisor before making any investment decision.
Aleck,
Yeah.
you're a scholar. I can't wait to unpack these all of what you shared in another episode. If you're listening to this podcast, please go listen to start at the very beginning, episode 221 of the Culture Matters podcast. And we will see you next time on the Culture Matters podcast. Share this with someone that has a passion for thinking about business and wants to align themselves in the world of the value investors like the Mungers and the Buffetts and the Arenas. And we will see you next time on the Culture Matters
Hey,
podcast.
hey, guys, not the same realm. Just want to let you know that. All right, see you guys. Thanks.